all you have to do is look at really the earnings growth of those businesses, and it's just not there to support the dividend yield. And even, this thirst that's just unquenchable thirst for yield is probably a misguided approach. Really, what people should be focused on are the dividend growth companies, and more importantly, those companies who can grow their dividends in the future, not necessarily those companies who just have the highest yield. I think that's a fairly troublesome area, especially coming off of 2014, where those were the strongest sectors, only to be the worst performing sector in 2015, and now again here we are in 2016, seeing the same thing repeat.
What are some of those names? Because if all of a sudden we're seeing a reversal of fortunes for utilities, for consumer staples, where should investors be moving then?
Yeah, it's just, if you look through the businesses that are in the S&P 500, for example, or any of the major indices, what you have to look for are the healthiest businesses, those high-quality companies. And we define that as those companies who can grow their dividends over time. Not necessarily the companies who have the highest yield, the companies who have a strong yield but can grow that dividend over time. Really, that's like a reflection of the earnings power of the business, but also of the management team's philosophy on where they see the business going. So if you think about things like Nike, Starbucks, some of the businesses that maybe are established businesses, but they've recently started to pay a dividend, or in the case of Nike, that have paid a dividend for years, but have always maintained the stability of that dividend, and of course followed the earnings growth right along with it.
Eric, if we look at the current payout ratios that we're seeing relative to historical averages for the large caps here in particular, where are we at there? And I just wonder whether we should also be looking at sectors like tech, because they have a lot of cash on the balance sheets. And actually, when I look at it, it looks like their payout ratio is actually very low compared to the average.
Yeah, that's what you have to really associate with is the companies that can grow their dividends, right? And so tech would be a perfect example of that. Tech has one of the lowest payout ratios of the entire S&P 500 sector. If you think about tech of the 90s, we had an entire industry or a sector that was just coming of age and really trying to figure itself out, not really in that stage where they could pay a dividend. But now we have companies like Microsoft or Intel or some of these major businesses that have a significant amount of cash on the balance sheet. Apple's a great example of that. And they can continue to now start to pay that cash back to the shareholders, but also to increase it over time. One of the things, speaking of payout ratios, that we've found is earnings can be so volatile that you can't really define it as an earnings or a dividend payout ratio. What you should look at is the free cash flow to dividend ratio. That's a much more meaningful figure of really that health factor and whether or not the business can maintain or sustain that dividend growth.